the secret to avoid Forex margin call. What is margin call? A margin call is what happens when a trader no longer has any usable margin. In other words, the account needs more funding. This tends to happen when trading losses reduce the usable margin below an acceptable level determined by the broker. Margin call is more likely to occur when traders commit a large portion of equity to use margin, leaving very little room to absorb losses. From the broker's point of view, this is a necessary mechanism to manage and reduce their risk effectively. To protect their traders, brokers provide margin calls to protect their clients' capital. Top 3 ways to avoid margin call in Forex trading. First, choose a broker with low margin call level. Every broker will set their margin requirement level, depending on various factors including the amount of leverage and the broker type. The margin level can range anywhere from 100 to 20, with the stop-out level being slightly lower than that. Various brokers will have varying levels, and you compare Forex brokers and find the one with the least amount of margin requirement level. Second, keep the leverage low. The larger leverage a trader uses, the less usable margin a trader will have to absorb any losses. When choosing a Forex broker, take note of the leverages they offer, because you may need to adjust your leverage, depending on market volatility. When there is little volatility, a higher leverage may be used to magnify the profits from small market movements, while the opposite can be done when volatility is very high. Third, always use a stop loss. Finally, the reason you get a margin call is because you didn't cut your losses early. Always remember to cut your losses early using a stop loss, so that you never get a margin call. The rule is to cut your losses early, and let the winning trades run as much as possible. Enjoy your Forex.